I'd now like to invite Christian Sinding, CEO of EQT, to join us. Under his leadership, EQT has quadrupled in size, became Sweden's fourth largest listed company, and a leading forward-thinking organization in private markets. Welcome, Christian.
Thank you. Good to be here.
So, Christian, what defines a truly great company for EQT?
It's the favorite question of the year, I would say. So interesting, actually, that I did a poll of my colleagues, that call it the top investors at EQT, and it came out very consistently, actually, into three different categories. The first one has to do with the industry or the sector that the company is in, and what we've sharpened over time is to find long-term themes in society that are not dependent necessarily on the economic activity, but on some other drivers, like digitalization of society, decarbonization of society, aging society, those kinds of broad themes that are going to run for a long, long time. Behind that, infrastructure actually is spot on in there. Then you go to the company, and we're looking for companies that have a great business model, recurring revenues in some form, some kind of competitive moat, if you want to call it that, to use your language, competitive advantage, and something you can continue to build on that has lots of opportunities to grow both organically through acquisitions and change. So that's kind of category number one. Category number two is leadership. So a couple of colleagues said CEO, CEO, CEO. And of course, we own the companies, we control the companies, so we can install the board, we can install the management if it doesn't already have a great one. But I think it's broader than CEO. I think it's the leadership group, it's the organizational design of the company, it's a cultural health. We heard a lot about these things earlier today. Culture beats strategy for breakfast, as they say, and I think we heard that for David and others. Very much true for EQT. So that's category number two. Maybe and also ability to attract and retain talent, very important. Category three is we also heard about from Otis and others, and even Novo Nordisk. It's actually the ability to take, the position that you're in, the strategies that you have, the leadership group that you have, and execute relentlessly, and drive, a culture of continuous improvement. So it's not good enough just to be a visionary, great CEO or a great team. You also actually to drive execution every single day. And if you think about the four companies that we heard about this morning, you find those themes across all of them in various forms, right?
Yeah, it sounds like you put a bit more emphasis on leadership than Chris does in his approach. What are you looking for in a CEO and in a leadership team?
I'm looking for someone who has a vision. Doesn't have to be visionary, but someone who has a real vision. Where are we taking the company and why? Someone who can bring people together, who can inspire, but also be sharp enough to execute, so combining those two elements I just talked about. I think the ability also to change your mind if a better argument comes, and have this mindset. You talked a little bit earlier about how do you deal with technological change and threats, and to have the mindset of, we call it future-proofing. What does the company need to stay ahead of the curve? What threats are coming, what opportunities are coming? Right now it's AI, then it'll be AGI, and then maybe quantum computing, whatever. All these things are impacting business, sustainability, decarbonization, all these. How do you deal with that? Do you wait to see what happens? Or do you take the bull by the horns and actually drive change? Those are some of the elements that we're looking for. And then not complicating things too much, sticking to what's important.
You mentioned long-term themes. Chris, is this approach that Christian takes on investing in long-term structured themes something that resonates with you?
Yeah. The average life of holding of our current portfolio is 8 years. Now, the average holding of a US stock is less than 1 year. So investors are absolutely en masse short-term, trading oriented, and So why, but we should ask, well, why is long-termism, is it a good strategy? Yeah, is it, why, and why?
I'd like to think it is.
Yeah. In this
Well,
house.
we should ask the question why. I always say justify. Yeah, and if you look empirically, it turns out that the very best companies, high ROEs, they stay good. They don't disappear overnight generally. Yep. And bad companies stay bad. Low ROEs stay low ROEs.
I totally agree. We have an expression: good companies are better than they seem. Bad companies are worse than they seem.
There's
So
persistence.
it's better. You got to get rid of the bad ones and just double down on the good ones.
Yeah, there's persistency. And the value of that company is only seen over the long term. So you get, they say there's no free lunch in finance, but actually I do think long-termism in a great company is a free lunch, because if you look at any sell-side model, they'll go out 3 years, or 2 years. And that's why? Because that's the time horizon of the typical buy-side investor, 1 or 2 years. But what if it can keep being good for 30 years? Then you're completely undervaluing that company. And people don't look at it because there are most companies, 95% are mediocre or bad companies. Yeah, and they meet their cost of capital, but they're not super companies. One of the companies, I mentioned aerospace, we invested in Safran. We've owned it for 13 years now. And we're actually one of the largest investors in the company. And we made around more than a 20% IRR for 13 years. It's a long period. The duration.
Very long.
Yeah, very long period.
What company was that?
Safran. Yeah, they were a joint venture with GE Aerospace in aircraft engines. And so we have investors who come in and say, well, we want new things.
Yeah.
Yeah.
Why is it so hard for investors to be long-term? I understand there
They think new is
are
better.
commercial pressures, but there must be more.
They think new is better. I say, do you
I think
change
it's
your
volatility.
Yeah.
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 One of the, I'm obviously interested in the private markets. One of the benefits of the private markets is you're kind of forced to invest for the long term. We own companies. We own them for 5 to 10 years at a time. Now we're actually starting to own them for longer, because we realize that winners need to be owned longer to really get the maximum value creation out of them as well. But you're kind of forced to invest for the long term.
Yeah.
And even in these products that now individuals can invest in our industry, they're also very long term in their nature. And our valuations aren't as volatile. You can discuss why, but it is because that we're not that interested in what it's worth right now. We're interested in what the companies are worth. When we buy a company, we're interested in what it's worth in 5 years or in 7 years, and what we can do with that business in the meantime.
Yeah.
And in the extreme, we don't even care what it costs so much today, as long as we know that we can take it to here, or we're highly confident we can do that with time. That's actually more important than what we pay 100 or 110 today. Doesn't really matter if you create 4 or 5 or 600 up here later.
So how do you do that? You identify a company that you want to buy.
Yep.
Pay a price that you're happy to pay.
Yeah.
And then what's the playbook to create the value?
Well, the playbook that we're trying to industrialize is we create a full potential plan for the business. We kind of dream, say, if this company had every resource in the world to be able to grow, develop, and go to the next level, what could it look like? If you did all the M&A you wanted to do, all the innovation, you get rid of the things that aren't working, upgrade the organization, improve the margins, all that kind of stuff. Okay, so that's the full potential. What can we actually get done in a reasonable time period with the people that we have involved, either globally or in the company or whatever? We bring lots of resources for the company, whether it's governance or IT skills or AI skills or sustainability skills or expansion or M&A, whatever the company needs, we try to bring those resources in. And then we push the gas pedal pretty hard and we go for it. And we very often don't meet the full potential plan, but that kind of mindset helps you drive the company forward, and also really deciding which are the big things. A little bit like Novo Nordisk we heard earlier. What are the big initiatives that can really make a difference, and then making sure that you put the best people behind that, enough capital behind it, and those things. That's what we can do in the private markets, and it's a lot of fun.
What can you do in the public market as an activist? And your approach has evolved a little bit over time.
Yeah, it's an interesting debate, private versus public. Because I do think the very best companies in the world are public companies. Not every one, but generally. And one of the reasons is in many industries, scale and scope matter. Small is not beautiful. An example of this is video conferencing, where Zoom, new innovator, brought out video conferencing, and Microsoft launched Teams and just distributed it free, integrated in their bundled Office product. Now, people say Zoom was a better product, but Microsoft won because they had this bundling strategy and they had scope. They had advantages of scope and the ability, customer relationships, and so I think people underestimate sometimes these powers of big companies of incumbency to crush a competitor, so a public market investor doesn't have no influence. Okay, if they're willing, they can influence, and sometimes stopping stupid things. And an example of Safran, we had this great company, reported 8 times earnings, it was compounding at 20%, and then one day they came out and tried to make an incredibly stupid acquisition of a company called Zodiac, a wild overvaluation using shares which were half their intrinsic value. So it was doubly bad. And we fought the deal, and in the end, they cut the price in half and then paid only in cash. And the share price doubled. We got sued by the seller. I was sued personally for 100 million euros, and my CFO came to me very stressed one night saying, it's all right for you, you can afford it, but they're going to bankrupt me. And because the seller lost €1 billion, but few investors will act like that. Yeah, most just accept it. But in the end, they cut the price and blamed us, which was fine. And all's well that ends well. They never did silly things again.
But then you have to, if I may jump in, you have to have a big enough ownership stake to actually have that influence, don't you, in some form, or at least a real voice that they will listen to. And the challenge in the public markets, if I may challenge that, is that often the companies become run by the management, right? Because they're ultimately the ones then with no active shareholders. They effectively appoint the board, and you have a bit of a
that can happen. It's a big
side of the coin. Yeah?
It's a big risk, and in general, maybe the general is there are many companies with bad governance that become badly run. Yeah. And I'm not a believer in being an activist in a bad industry or a bad company. That doesn't make any sense. But there is I don't actually think the shareholding necessarily is everything. Can matter. We went recently on the board of a company called Cellnex, cell phone towers, and we had 10%. And so it mattered because there were four shareholders with 10% each, and so it was very concentrated. But I think the power of the argument can win. Shareholders are not stupid. Norges Bank is not going to be an activist themselves, but if an activist makes a good case, they'll support them.
Yeah, they'll listen.
Yeah, they'll support them. Whatever stake the activist has, 1%, 2%, it doesn't matter. So
And can we go back?
Yeah.
Can we go back to this
Sure.
statement that you had that the best companies are public? I don't really appreciate that one. So maybe I give some examples. But I do agree with you that having companies that are strong, large, winning, beating the competition, whatever. One is very interesting that we own, which is the world's largest private education company. It's a $15 billion company. But it's only got 5% market share around the world, growing organically through acquisitions, super purpose-driven, doing very good for society. And the competitors are, moms and pops all around the world that don't have the resources to invest in AI and the next generation of education and stuff like that. That is a brilliant company. We've actually had it public twice, but the public market didn't appreciate it. So we've taken it private twice, and now we're just going to keep it private, hopefully for as long as we can, and just build and build and build. So I think the world is also changing because private equity has gotten so large now, and we can move companies into longer-term ownership structures. So we can actually, I think we're going to see more and more of the best companies in the world either stay private or go private and grow. And that's a big difference. And that's one of the things we're seeing in the market. While you heard, a number of public companies is shrinking a lot over time.
And you alluded to the importance of control. You tried an approach, a private equity approach in the listed market with the EQT listed.
I hope we didn't have time for that one.
Maybe some reflections and lessons learned?
Yeah, we did. We tried to start a mini version of what you do, and we failed miserably, actually. After we shut the fund down last year, we delivered back like 90% of the capital that was invested or something, a little bit worse than that. And luckily it was very small. And when we realized we weren't good at it, we actually did shut it down and focus on what we're good at, which is private markets. I think we tried to apply the models that you've heard me think about here and talk about here in a public setting where we didn't have the toolbox, we didn't have the understanding of how to drive influence. Mm-hmm. We thought we would have more impact being who we are, and it didn't work. So it's really about, it's a lot of learnings in there, back to really sticking to your guns and doing what you do well, and more of that.
There's, like everything, there's pros and cons, arguments for and against, but in private equity, you pay a price for control. You pay a premium.
Yeah.
Can be big.
Mm-hmm.
So don't get me wrong. Control has a high value. Has a value. Let's say it has a value, but is it worth 40%? Or whatever premium you have to pay in a competitive auction? In public markets, there's an offer every day. Mm-hmm. Yep, you can take it or leave it, and so it's. I think so I just think that point is relevant. Entry price matters, and
yeah. Do you think liquidity is overvalued in the markets?
Well, the thing is,
why do people need liquidity as much as they think they do all the time?
You can be wrong. That's something I learned. The Yellow Pages example was,
yeah.
And if you're, if you're wrong in private, there's no way out. Yeah, in a short term, and if you're wrong in a public, you have a chance to get out. Yeah, you have a chance.
But you don't really have a chance to repair and improve, which you do in private. Right, we can,
to the extent
we can huddle down, change the management, change the board, divest underperforming operations. So it's just a completely different mindset.
To a point, yeah. There's we were investors in cable, in the US, and
we own a lot of cable.
Charter and Communications, and before that Time Warner Cable, and it was a great investment for 8 years. We made 5 billion of P&L and 5 times our money. But then the industry started to deteriorate. It became saturated and more competitive, and people started overbuilding private equity. Yep,
we bought lots of those companies.
Yeah, so they started overbuilding.
One of our best sectors, actually.
And I sold, because it changed.
We were buying.
Yeah.
Yeah. Unfortunately, we are at the end of the session already.
That's too bad.
I would love to continue for much longer.
I learned a lot.
Chris, you shared many of your secrets. You shared more in a podcast that you recorded with Nikolai, which will be released on the 14th of May. So I encourage everyone to listen to that one. We'll take a break now. So please be back in this room at 15:25. But first, and most importantly, a big, big thanks to both of you for sharing your insights and wisdom.
Good to meet you. It was fun.